It was a good week in the markets, and it's on the back of a quick, a clear and a decisive result, which I think was really helped drive what was an anticipation of a pro-growth agenda.
Jane Fraser has some very big news about the future of the banking industry, and it's looking good for a lot of XRP holders.
And we saw that clearly as beneficiaries in the bank sector. We saw it with small and medium-sized companies as well, and obviously some of the tech stocks that are here today.
Does it change the outlook for your business?
We're expecting some lighter regulation. We'd already been having some pretty constructive discussions with Chair Powell, and we're heading, I think, in a better place with Basel III. That will help access to credit. That will benefit the consumer. That will benefit smaller and larger companies in their access and cost of funding. So we're expecting broadly this to be pro-growth and beneficial.
I am curious what happens to Basel III, because the original proposal was the 19% increase in capital, and then they came back with a 9% increase in capital, but that didn't pass. So what is your expectation at this point? That it gets delayed further? Could it go away?
I think there are a variety of different scenarios that could play out here. We will have to wait and see what happens, but our expectation will be that it will be the lighter version. I think any bank CEO will tell you we feel very well capitalized indeed.
You've probably heard endless discussions about how big crypto is going to be, how it's destined to become one of the largest asset classes out there. But maybe you're sitting back, looking at the market and thinking, is this really all it's hyped up to be? Well, that's exactly what we're going to address by pulling from real-world examples and insights from key players like Citi, the DTCC, and the BIS. Let's start with the DTCC. Back in July 2024, the global head of their digital assets division talked about the need to reimagine the plumbing of the financial system using distributed ledger technology. Now, the DTCC isn't just any player. They're responsible for settling $3 quadrillion in securities transactions every year, and that figure grows annually. Their vision involves creating a virtual, global centralized securities depository, enabling real-time asset transfers. They're even looking ahead to markets potentially trading 24/7. Imagine a system where money and assets move with near-instant speed across the globe. It's ambitious, no doubt, and timelines like within the next year might seem a bit optimistic. But keep in mind, this is one of the largest institutions in finance talking about these shifts. We don't always know what's happening behind closed doors. Still, this kind of innovation is exactly what's needed to modernize a financial infrastructure that's been around for decades.
So as one famous Bostonian once said, the institutions are coming, right? And we're starting to see progress where more certainty in the market is helping institutional adoption, such as the approvals of FIT21, other instruments, both ETH and Bitcoin, spot ETFs. Those have been super helpful in pushing the movement forward. It just shows you there's pinned up demand. It is pushing through. There's a couple of things that are a little bit different about this. This is the first time in our history where we've seen actually retail lead and institutional follow, but the certainty that we're getting right now from the regulatory and the legal framework is helpful, and we'll continue hopefully to see that progress. Also, the use cases that Dan talked about, they have a common denominator here is they bring more efficiency into the process, right? We know how to manage collateral, we know how to do all these things. A firm like DTCC or most middle and back offices have done historically is really the bridge between the inefficiencies of the markets, the front and the back office. This technology, blockchain accentuated by tokenization, helps free up these processes, create more efficiencies, both on the cost as well as on the revenue side.
Now, let's shift to another perspective. PwC released a report titled Navigating the Payments Matrix, Charting a Course Amid Evolution and Revolution, Payments 2025 and Beyond. The report paints a clear picture of change in the payments landscape. Digital wallets and cashless transactions are gaining ground fast. By 2030, cashless transaction volumes are expected to more than double, driven by digital payment adoption. At the same time, regulators are pushing for stronger domestic infrastructure, forcing international card networks and processors to adapt or face irrelevance. The infrastructure behind payments is evolving rapidly. By 2025, 80% of financial institutions expect to have outsourced cloud and platform infrastructure. Meanwhile, digital wallet providers are adopting open-loop technologies, prioritizing interoperability to keep up with the globalization of payment systems. What this all means is that the way we process payments is changing fundamentally and quickly. The World Bank offers another layer to the story. They've been emphasizing the need to upgrade their plumbing, a metaphor for the internal systems that drive their global programs. The president recently explained how they're working to integrate their efforts across sectors like education, infrastructure, and agriculture. The goal is to create a unified impact where programs not only deliver their immediate objectives, but also help generate jobs and improve livelihoods. Speed is a big focus for them. They've cut approval times for projects dramatically. Some African healthcare initiatives were greenlit in under 100 days, while a correspondent banking project in the Pacific Islands covering 7 countries was approved in less than 10 months. The urgency reflects a broader need to modernize systems to match the pace of global change. Across the board, we're seeing technology accelerate this transformation. AI, blockchain, and digital wallets gained serious momentum during the pandemic, and that trend is only picking up. Geopolitical factors like efforts by BRICS nations to de-dollarize and create alternatives to existing financial systems are also pushing this shift. We're watching a transition from paper-based systems to digital ones. And it's no longer just theoretical. It's happening now.
We feel the US financial system, it's the best in the world, and we want to make sure that it continues to be competitive and a global strength for America.
Speaking of the best in the world, there is this question mark of tariffs. I mean, President Trump, all throughout the campaign, has been pretty clear and consistent that they will increase, and you are the most global bank, so I'm wondering how you expect that to influence the global economy and the U.S. economy.
What we've often found is that what's said and then what actually gets happened tends to be more of a negotiating ploy to get certain expectations too high, and then we'll see what actually passes. These things take time. Tariffs, tax policy, they don't tend to happen overnight. This is going to take a bit of time to play out. There'll be some winners and losers. At the end of the day, the goal there is to drive more activity into the US. So I think for the US, broadly, it will be beneficial, but we have to wait and see what the actions are.
On our panel last week in Riyadh, you were fairly optimistic and positive on the US economy. Does your outlook now improve further? Has it changed?
The US economy is resilient. I mean, it continues to surprise to the upside when we look at the third quarter. And it's a combination of push and pull factors here. And I think some of the pull factors will just be amplified.
One of the most exciting developments is the rise of tokenized deposits. These are essentially tradable bank deposits, integrated with traditional systems and connected to platforms like FedNow. Blockchain technology is becoming the backbone of financial systems, improving the plumbing of transactions for institutions globally. For instance, in North America, 99% of circulating stablecoins are tied to the US dollar. High-value payments in 2021 alone totaled $1.4 quadrillion, and 88% of all foreign exchange transactions involved USD. These numbers highlight just how significant this shift is. What's clear is that everything about how we handle money and transactions is transforming. From payments to securities, from legal frameworks to tokenized assets, the global financial system is undergoing a massive overhaul. While it might not always be immediately visible, the changes are happening, and they're accelerating. We're stepping into a new era of finance that's faster, more efficient, and built for the demands of a digital world. The financial system is undergoing a transformation on a massive scale, a shift so profound it's being called a once-in-a-lifetime opportunity by those at the very core of global finance. The plumbing of this system, which has long been built on traditional structures, is now integrating digital assets, tokenized deposits, and entirely new architectures like FedNow. These aren't just incremental upgrades, but the groundwork for a revolution, laying the foundation for what comes next.
But whatever can be tokenized should be tokenized, and we would like to be part of that support infrastructure to allow them to better understand what it is, understand the financials, understand the risks, and hopefully make educated decisions as they move forward. So there's the short term that we're dealing with and a lot of the medium to longer term challenges that Dan and the team are trying to resolve.
Jane's point is a good one, that interoperability, this ability to bridge between legacy systems and the new blockchain rails is a critical enabler. You shouldn't have to make a choice to go to the digital world and then never come back, or to stay where you are. And a big part of that is, again, making these technologies accessible and interoperable. So they have to meet the accounting, risk management strategies of institutions. They have to be easy. If I have to teach my mother how to use a wallet in order to invest, it's just not going to happen practically and easily. So a lot of the technologies that we're building out, that are being built across the industry, are designed to simplify, make it easy for folks to enter. And what you see in terms of interoperability is there's a proliferation of ledgers. What we expect is innovation will continue in ledger technologies for indefinitely. In order to be able to meet the scale requirements that we just mentioned, you'll see that ledger technologies, there will be many.
Digital asset use is spiking as mainstream adoption surges, bringing more participants into the fold. The integration of tradable bank deposits within the existing framework, especially through platforms like FedNow, is already underway. The role of these tokenized assets is becoming increasingly central, connecting disparate parts of the global system. This isn't just a theoretical shift, it's actively reshaping how money moves, from cross-border transactions to everyday payments. Jane Fraser, the CEO of Citi, has been explicit about the scale of this transformation. She describes it as a once-in-a-lifetime shift, where global finance is being unbundled from its legacy systems and rebundled into a streamlined, largely digital architecture. This isn't just evolution, it's a revolution. Over decades, trading went through similar changes, but the pace we're seeing now is unprecedented, driven by the need for faster, more efficient, and scalable solutions. Citi itself provides a glimpse into this scale, processing over $4 trillion daily across 144 currencies and 160 countries. They're reshaping their operations to remain relevant in a world that's becoming more global and local simultaneously, faster, more complex, and undeniably digital. Fraser warns that if traditional systems remain slow and cumbersome, it will only accelerate the rise of alternative systems that are faster and cheaper. The regulated sector can't afford to fall behind. Organizations like SWIFT must not only keep pace, but also lead in modernizing their systems. The alternative? Unregulated financial systems that scale globally, challenging the dominance of traditional banks and central authorities. It's a scenario that risks undermining the stability of the financial sector and its ability to serve consumers effectively. The solution lies in relentless modernization, with public-private partnerships and industry collaboration pushing the regulated system to innovate at the same speed as its unregulated counterparts.
And if our target is near instantaneous settlement, then data has to agree across all of these ledgers. And this is why our partnership with Chainlink is so very important, because this allows us to write data once and have it proliferate across all of the networks, to move value freely between whatever the best ledger technology is of the day, so that we can meet the high volume requirements that are coming, and we continue to innovate as ledger technologies grow. I see markets becoming unified. So we have separated public and private markets. We have separated debt and equity instruments. We have separated cash rails and commodities rails and securities transaction rails. We have markets that are separated by jurisdictions globally. Blockchain makes it possible for all of these rails to come together and for us to have unified markets, which makes them much more accessible. As Nadine mentioned, individuals don't get easy access globally to investment opportunities. And so by bringing all of these marketplaces together, making transactions extremely efficient, we're able to get to markets that are more fair and more open in the future.
This is where the big players like the BIS and central banks come in. Their focus on enhancing cross-border payments, integrating liquidity flows, and enabling seamless interconnectivity is central to the transition. It's no coincidence that these discussions have taken center stage at major policy meetings. These aren't abstract ideas. They're critical steps in shaping a system that can handle the demands of the modern economy. Ripple and XRP are central to this conversation. The technology behind XRP has always positioned it as a leader in enabling real-time settlement and driving efficiency in cross-border transactions. As the world transitions to a tokenized economy, projects like these could play a pivotal role in bridging the old with the new. Diversification remains key because the full impact of this shift is impossible to predict, but ignoring these developments altogether would be a missed opportunity. The transformation isn't coming, it's already here. The pace of change is only going to accelerate, and with it comes the chance to align with the future of finance. This is the moment to recognize the opportunities, plant the seeds, and position yourself for the digital age of value. Those who fail to act may miss out on what could be one of the most significant financial shifts in history. Since last September, when Citi's CEO Jane Fraser revealed the bank's largest reorganization in nearly 2 decades, the bank's shares have surged more than 50%. While this sounds impressive, it's not a unique achievement, as rivals JP Morgan Chase, Bank of America, and Wells Fargo have seen similar gains. Despite this uptick, Citi remains undervalued compared to its competitors, with a price-to-tangible book value ratio of just 0.7, the lowest among the major U.S. banks. The biggest hurdle to Fraser's efforts to revitalize Citi is regulatory pressure. The bank is still working through 2 consent orders from regulators, addressing issues in its risk management, data management, and internal controls. Even though Citi has spent billions to resolve these concerns since the orders were imposed in 2020, regulators recently fined the bank $136 million for insufficient progress. U.S. Senator Elizabeth Warren has been vocal in calling for growth restrictions on Citi, arguing that it has become too big to manage. An asset cap which prevents the bank from increasing its balance sheet beyond a certain level would severely limit Citi's ability to grow revenue and earnings. Fraser reassured investors during the third quarter earnings call that Citi is not currently under an asset cap and does not expect one. However, the potential for such a cap is still a looming distraction, particularly after regulators impose similar restrictions on Canada's TD Bank. The bank's latest earnings report shows there is still significant work to be done. Citi's return on tangible common equity, RU8, was a lackluster 7%, and net income dropped by 9% due to rising defaults on credit card loans and a decrease in net interest income. On the bright side, Citi's Services Division, which handles working capital and payment solutions for companies, performed well, and the bank's investment banking division had a strong quarter, similar to the broader Wall Street trend. Citi has been aggressively cutting costs, with third quarter operating expenses down 2% year over year. However, its efficiency ratio, expenses as a percentage of revenue, was 65.2%, still higher than Bank of America and JP Morgan, which reported ratios of 53%. The regulatory cleanup process is costly and complicates efforts to bring down Citi's overall expenses.
What's the toughest part for you to cut costs in order to get to the targets that you've set out for yourself?
We're making sure that we both get the bank to be more efficient and get it to be more simple. So that modernization and simplification agenda is very important. That also means investing. The transformation that we're doing is both addressing some of the regulatory issues that were raised, but they're also in the benefit of shareholders, because ultimately they drive to a more efficient, modern organization. We also need to be investing in our businesses, so it's driving forward on critical investments and platforms that will help support our competitive advantage, and it's simplifying the bank. We've successfully reorganized the institution. We've realized benefits from it. We've realized benefits from the cost takeouts we've done from divesting. For me, it's about getting it right. I don't want to take short-term fixes and shortcuts at the expense of making sure that this bank is run well, properly, in the benefit of all stakeholders.
While Fraser is focused on making Citi more agile and financially robust, the ongoing regulatory challenges could hinder the bank's recovery, raising questions about whether it can continue its turnaround without facing further restrictions. Do you agree with Jane Fraser's assessment? Let us know in the comments.